Andrew runs a company that buys and leases office space in major cities around the world. The company has a large portfolio of properties, each of which was bought using money borrowed from either banks or bond investors. Since the properties are spread across different countries, Andrew makes and receives payments in numerous currencies on a regular basis. Since the payments are mostly for fixed amounts, rental income on one hand and interest payments on the other hand, he also has a good idea of how much of each currency he will pay or receive every month. What does Andrew do with all of these different currencies? One currency can be bought or sold with any other currency. Each currency is worth different amounts of other currencies. For example, $1 might buy 100 Japanese yen today, and at the same time, €1 might buy $1.3. The price of each currency changes on a continuous basis. The trading of currencies is called foreign exchange, or FX, and it is the largest market in the world. Trillions of dollars worth of different currencies are traded every day. In Andrew's case, he exchanges the currencies that he receives into whichever currencies he needs in order to make his interest payments. If he has the cash amount of a currency in hand, then he can exchange that currency immediately. This is called a spot trade. But what about the risk of currency rates changing through time? Can Andrew protect himself from this risk? Since Andrew has a good idea in advance how much of each currency he will need, he can agree the rates that he will buy and sell currencies in advance too. So, he can agree with his bank today to sell £1 million British in order to receive US dollars, but the exchange will actually happen in a month's time. The date of the exchange can be different for each transaction that Andrew agrees with his bank. These agreements are called forwards because they refer to exchanges that will happen at a date forward in time. The forward rate is calculated to take into account the different interest rates offered by each currency. Forwards are useful for Andrew because he can fix the rate today for exchanges in the future, which gives him peace of mind. In summary, the current low interest rate environment means that bond investors have to take more risk in order to gain an attractive return on their invested money. The current low interest rates also present a risk that if interest rates and inflation rise in the future, then bond prices may fall and portfolios could suffer losses. Therefore,